Hello and welcome to Crescent Private Wealth's November 2025 market update. My name is Omar Bassal. The agenda for today is to cover first economic news, followed by a discussion on U.S. interest rates. Then we'll discuss U.S. stocks, as well as non-U.S. stocks, and then we'll wrap up with a discussion on Bitcoin. So, with respect to economic news, the longest U.S. government shutdown in history, which lasted 43 days, disrupted many economic reports that the markets normally rely on for direction. The previous government shutdowns did not have the same impact on these economic reports. This one is unique, and frankly, it's difficult to assess the state of the economy without many of these reports. There are non-government reports that universities and corporations do release, but they typically are not as impactful, as meaningful as the ones that the Bureau of Labor Statistics collects and releases. The September jobs report was released 6 weeks late. The October jobs and the October inflation report will actually never be released. The government said we can't go back in time and collect the data that we would normally have collected, so those are simply lost in time. The September jobs report showed a net new job creation of 119,000 jobs, while unemployment rose to 4.4%. So, that can sound a little bit conflicting, but it just means that the number of new jobs created was insufficient to meet the number of people looking for work, and therefore there was this uptick in unemployment as more people were looking for work as compared to the previous month. So unemployment rate, the U.S. unemployment rate is now sitting at the highest level since October. So the chart in front of you is the unemployment rate going back to 2021. And you can see that we're sitting at 4.4%. And that is the highest since October of 2021. It's not necessarily alarming. It's just an indication that the economy is weakening, and it's something to monitor, to track, to make sure it doesn't start to go too high. But obviously, in a recessionary environment, the unemployment rate will spike, but we're not there yet. You can see following COVID how high the unemployment rate had risen to on the left side of the chart there. Let's look at interest rates. So in September and October, the consensus among market participants was that the Federal Reserve would be cutting interest rates at their October and December meetings. So just as a small kind of recap of history, for most of 2025, the Federal Reserve had not been cutting interest rates. They were seeing good economic growth, and they were concerned about inflation. They made their first cut in 25 in September. They lowered it from a range of 4.25% to 4.5%. They lowered that to 4% to 4.25%. And then in October, they made another cut. They lowered it from the 4% to 4.25% to a range of 3.75% to 4% range, where it currently sits. Now, while the Fed cut in October, as I mentioned, federal officials have been downplaying the certainty of another cut at their next meeting, their last meeting of the year in December. And while a cut may not occur at that December meeting, I think it's more appropriate to look at the longer term picture here and understand that President Trump will be appointing a new Fed chair in May of 26, and he has indicated many times his desire for much lower rates. So he will be putting someone who will be much more open to lowering rates significantly. Now, obviously, the Fed chair doesn't have superior voting ability. He's one member of the voting of the Federal Reserve Board members that is voting, but still he can influence. He can, use his position as chair to kind of corral people So definitely, I think rates will be falling further next year. This is a chart showing you the historical Fed funds rate. This is the short-term overnight rate the Federal Reserve controls. And you can see, like in 2018, it was around 2%. And then when COVID hit, the Fed basically lowered it to zero. That was to stimulate the economy and really kept it there too long. And then what happened was inflation spiked. I mean, not only because of the lower interest rates, but because of other factors such as, the disruption in supply. And then when the Federal Reserve realized that they were behind the curve, they raised rates very rapidly in 2022 from basically 0 to 5%. And that's what caused that market, the U.S. stock market, to really had a very bad year in 2022 as a result, because essentially stock price valuations move inverse to interest rates. So higher interest rates, lower valuations, lower interest rates, higher valuations. And then the far right of this chart just shows you a dotted line to show you what the expectations of a third-party firm called BCA Research, what they're expecting for the direction of the interest rates. So you can see here they're expecting cuts. Again, December may or may not happen, but it's inevitable given the president's choice for Fed chair and his efforts to appoint other Federal Reserve members that will be more open to a cutting cycle. Let's discuss U.S. stocks. So U.S. stocks peaked in October and have since declined on concerns around valuations and the prospect that the Fed will not cut interest rates in December. So once the Fed chair had Jerome Powell said that there's no guarantee of a cut in December, that led to some decline in the market. Now, you should know that the biggest market declines occur around recessions, and so far, a recession is not expected. So this is why the current market pullback is not likely to be the ultimate peak in the U.S. market. The ultimate peak will occur, a little bit before the start of a recession, and there's not clear evidence that that's the case. So this is the S&P 500 index, and you can see here that peak that occurred in October. Since there's been a mild decline, nothing serious. It's very normal, but it's not necessarily the events currently at play don't suggest that this is the ultimate peak. Like, ultimate peaks typically happen around major events, whether it's like the COVID crisis or the global financial recession, or the peak you see here in February was around the introduction of the tariffs, and even that wasn't the ultimate peak. You can see the markets recovered relatively quickly. This is a nice table or chart because it shows you the sectors in the S&P 500 index that are generating earnings growth, or how much earnings growth the sectors are generating. So you can see on the far right that energy has just been a big laggard. So energy companies earnings are declining 15%, annually. Now that's expected given where energy prices are. So oil, natural gas prices have been pretty weak. You can see consumer staples have also have posted negative earnings growth, industrials, real estate, utilities. And then as you can get to the left, you can start to see here that, materials, which includes like mining companies like gold, have gold miners. You can see they've done pretty decently. Healthcare, this is centered around the, GLP, the introduction of this class of drugs, which helps people lose weight. It's been a boon for a lot of healthcare companies. And then the far left, you can see it's really the tech and the communication services is a lot of it's got telecom, it's got media, it's got cable companies, but it has a lot of technology-related companies as well. So it's really the tech which is just generating massive earnings growth, and that explains why they've done so well. Let's talk about non-U.S. stocks. So global markets have generated substantially higher returns than US stocks. This continues to be the case. US stocks are more expensive than global stocks. However, US companies have grown earnings at a faster pace than global companies have grown earnings. So that partly explains why US stocks are more expensive, but given how expensive they are, it's harder for the US stock market to keep up with global indexes. The artificial intelligence growth has driven a lot of the earnings story in markets like South Korea and Taiwan, and I wanted to share with you an interesting chart which really brings that to life. So let's start first by showing you the performance of global markets from the beginning of this year through November 23rd. So far right, we have Denmark, which is really because of one company called Novo Nordisk, which was the maker of Ozempic and on the first to scene, and then fell on hard times as other companies started offering competitor products that could be taken by pill instead of by shot. But that Denmark's a little bit of a unique case because Novo Nordisk represents like so much of the market cap there. But aside from that, you have like Turkey, Saudi, Indonesia, Thailand, India, Malaysia on this far right. And then if we go to the far left, who's really been leading the charge has been South Korea, Spain, South Africa. South Africa driven by obviously commodities, gold. South Africa has a lot of mining companies. Poland, as the prospect of an end to the war in Russia and Ukraine seems to be coming closer. Mexico, Italy, Brazil, Portugal, Hong Kong, Netherlands, Singapore, Canada. Where's the U.S.? So you can see here the U.S. is actually towards the far right, actually. So U.S. has really lagged most of these global markets. And you can see, by the way, these returns of some of these markets is incredible. Like South Korea is almost 80%, Spain 60 plus, South Africa. Now, keep in mind that part of the return is from the market rising, but part of the return is from the dollar going down. This is an interesting chart because it compares how expensive US stocks are to non-US stocks. So the dark line is a valuation measure for US stocks, and the circle is showing you that US stock market valuation on this particular measure is around 22.5 times. But if you look at the non-US stocks, you can see that valuation is around 15 times. So non-US stocks are substantially cheaper than US stocks, which may be one of the reasons that they're outperforming. So let's talk about AI. This left chart shows you the amount that just 4 companies, Meta, Google, Microsoft, and Amazon, are spending. This is per quarter. So, back in 2021, the spending that they would be doing, on basically investments and expansion was around, let's say, in 2021, it was around maybe $25-30 billion a quarter. And then in ChatGPT was released, I think is late 23, if I'm not mistaken. And then you can just see this hockey stick kind of massive growth as they're now all trying to have the AI in their business to develop tools for AI because they see the potential here. So now roughly on a quarterly basis, every 3 months, those 4 companies are spending about $100 billion every 3 months. Amazing. But is this all being spent in the US? So the chart on the right shows you quarterly data of a specific field that the government releases on exports, net exports of computers, peripherals, semiconductors, and so forth. And so what you're seeing on the right-hand side is that in the U.S. as a whole, there's been about a negative 70 billion net exports in a specific sector of computers, semiconductors. Now, a negative net export means it's an import. So what is this saying? It's saying that Meta, Google, Amazon, Microsoft are spending massive amounts on AI, but a lot of that money is not being spent in the US. it's being spent overseas. And that's reflected by imports from overseas. And the imports are shown in that chart as a negative. So a positive would be positive means that on net we're sending out more abroad than we're importing, but a negative number of the right-hand chart means that we're importing more than we're exporting. So again, this can explain why the South Korea is number one performer, because they're benefiting from a lot of that spending. And finally, we'll discuss Bitcoin. So Bitcoin prices fell in November due to declining prospects of a Federal Reserve rate cut at the meeting in December. So Bitcoin is very sensitive to that. When interest rates are very high, Bitcoin can do poorly. When they're low, they can do better. Bitcoin has diverged from gold prices, which have actually been supported by central bank buying, especially China. So gold prices have actually made new records highs, whereas Bitcoin has not been able. So obviously central banks globally have not adopted crypto or Bitcoin as a reserve asset in mass. And so therefore Bitcoin prices have not been benefiting from central banks diversifying away from the dollar. Bitcoin will come back into favor once the Fed cuts interest rates and risk sentiment returns. So chart just shows you the NASDAQ composite, which is the dark line, and then Bitcoin prices, which is like the greenish line. And so it's interesting to note how the peaks and troughs of Bitcoin really do follow NASDAQ, but obviously most recently the Bitcoin has fallen more than the NASDAQ. We've seen this before, where Bitcoin can fall into some kind of urgent selling pressure, but historically, at least, cooler heads eventually prevail, and Bitcoin has been able to recover. So I don't think this will be different. It just might take a little bit longer. So do appreciate your time, and we look forward to our next monthly market update.